So I think that any given FOMC meeting is not that relevant. So a 25 or 50 basis point change is not particularly relevant. Now, if we start talking, replacing a Fed chair and other parts of the committee and then getting like a 300 basis point cut or something like that, I mean, that starts to become meaningful. So magnitudes matter. If we're running at 1% to 2% interest rates, that's a different environment than 400 basis points and change. Now, if you look at kind of the purpose of interest rates, like what the central bank's trying to do, they're obviously their mandates are unemployment and inflation, but then the question is, what are they hoping to do with interest rates? Why does that matter? And what the Fed mainly does is impacts bank lending. That's kind of the whole purpose of the interest rates is in theory, higher interest rates would slow down bank lending by making borrowing more expensive, whereas cutting rates makes borrowing more attractive, and you kind of restart the credit cycle. Now, the problem is that when you're in fiscal dominance, bank lending is not the main source of new money creation. So, for example, back in the 70s, when baby boomers were entering their home buying years, which is peak credit formation, we had the highest historical rate of bank lending in the country. And so the money creation was largely led by bank lending with some fiscal on top of it. Obviously, you had the Vietnam War, you had Great Society programs. These were adding to it, but there was more money coming from bank lending. So when Volcker jacks up interest rates, he did meaningfully slow down bank lending. And the problem is that this entire cycle, starting before COVID, during COVID, after COVID, none of this was really caused by excessive bank lending. It was all that really large fiscal stimulus that was monetized. So the Fed is trying to kind of slow down bank lending, which is just not really the key thing here. So their handful of interest rate changes don't make a huge difference in that sense. Where it shows up, if they do a massive cut, you probably get a weaker dollar. You probably get a boom in emerging markets because they have all that dollar-denominated debt that gets relieved. That can cause a kind of more demand for commodities in general, including energy, which could be somewhat inflationary. Around the margins, they can restart lending to some extent. The challenging thing is that we see them talking as though short-term rates and long-term rates are the same thing, which they're not. So the Fed primarily controls short-term rates. And what we saw is that just because they trim short-term rates doesn't necessarily mean that, like, say, mortgage rates go down.
The bond market didn't buy it at all. I mean, we saw yields go up, right?
So they didn't buy it. So and now maybe so let's say they cut 300 basis points, they just completely kill the short end. There's two outcomes that could happen. One is if people are not getting interest rates on short-term paper anymore, maybe they will bid for the longer end. They'll buy long duration treasuries and mortgages. Maybe they will drive those down to some extent. Or they could say, well, this Fed's not serious about inflation. Why would I want to own the long end of the curve? And they could sell it off. So there is actually unclear how that would play out in fiscal dominance. It wouldn't necessarily lower actual borrowing costs. And it didn't last time. Yeah, the small sample we have so far this cycle is it didn't. Now, whether a bigger one or a second one would, I mean, market conditions could change. If you have tariffs and the economy slows down, then maybe you get a different result. I wouldn't want to fully say it wouldn't do it, but they're just not the same thing is the point. The longer end is more set by the market, especially when the Fed's not actively buying and selling a ton of securities. If anything, right now they're trimming their longer end securities and mortgages. I think the Fed is less relevant. It's not irrelevant, but it's less relevant than probably the market thinks. The size of the fiscal deficits is more relevant, and the tariffs are more relevant. Basically, if we're gonna have 400 plus billion in new taxes this year, that's a bigger variable, I would say, than 50 or even 100 basis points from the Fed. You have to get into a lot bigger hikes or cuts to really start having an impact of that scale. There's different types of yield curve control. I mean, during the height of the pandemic, the lockdowns, the Fed openly talked about yield curve control in their meeting minutes when they were kind of stabilizing the bond market. They dropped that. They didn't have to go that route. Right now we see kind of talk about politicization of interest rates. That's not new. I mean, for example, in the prior administration, you had Elizabeth Warren. She was on the Fed's case about trying to get rates down. Now we have the Trump administration on the Fed's case trying to get the rates down. So everybody in power.
She's still on it too, I think. So
yeah, probably
one thing they can agree on somehow.
Yeah, they both want. Yeah. But I do think that one of the outcomes of fiscal dominance is you tend to get less separation between the government and the central bank, because the central bank, whether they like it or not, generally has to step in and put out fires. An example of that is when the Bank of England had the gilt crisis in 2022. So they announced a budget that had a bigger than expected deficit. They're not the reserve currency, so they have a parliamentary system, so they're a little bit more volatile with some things that happen. And basically, their gilt market sold off. They had leverage in the market that kind of resulted in more sell-offs. And so the Bank of England, it's kind of comical. They had, so inflation there was like 10% at the time. They were going to start balance sheet reduction, quantitative tightening, and they had to cancel a conference about balance sheet reduction to instead go and buy gilts to put out the fire. Now, once they put out the fire, then they eventually got to a period of quantitative tightening as they planned. But the point is they had to drop everything they were going to do and buy government bonds with new kind of temporarily printed money to put out a fire. And that's generally what happens when you start to get more toward fiscal dominance. And in the U.S.'s case, we have a situation where the Treasury has been more active in what they're doing. So people have called this activist Treasury. And other things. It started under Yellen. So far, it's continued under the current administration, which is that they can do things like shorten the average duration of their debt. They can issue a higher percentage of their debt as T-bills, which is where there's more demand for it. Rather than term out their debt, they can refill their cash balance less quickly than they might otherwise would. They have different levers they can pull that are, in some cases, roughly equivalent to a handful of interest rate cuts or a little bit of quantitative easing, for example. But basically, you get less independence. The Fed, if you look at the New York Fed's annual report on the state of their kind of securities book, they plan in roughly a year to go back to gradual balance sheet increases. They probably wouldn't call it QE at the time unless there is a recession, but they'll be ending their period of quantitative tightening and go back to gradual increases in that. Whether we get outright yield curve control, that's a very politicized thing to happen. And it's hard to do without a major acute crisis. So, for example, when it was done in the 1940s, it was World War II. So nobody was looking at treasuries. They're all looking at what's happening in the Pacific, what's happening with Europe, and there was a very kind of raw knit together culture at the time. It was a very centralized culture in a way. We don't really have a reason. It's decades of kind of bad decisions have caught up to us is the answer. And we just kind of gradually build up this really big debt burden with interest rates that aren't going down anymore. So we need to do yield curve control. That gets really sloppy. So I think they're going to try to push it off. But I do think that there could be various kind of yield suppression techniques that keep it somewhat below what the market might otherwise settle at. I think the problem is that, like I said before, when there's fiscal dominance happening, there's really no right answer by the Fed. If they cut interest rates too much, it causes problems. If they keep interest rates high, they're just blowing out the fiscal deficit more than if they had it low. So it's not bank lending that's the problem. I think the best thing they could do is be transparent and just say, look, this is primarily a fiscal issue. We're going to try to make bank lending happen at a moderate pace with the tools we have, which is what we're doing now. But we don't really have good answers here. That's why I would hate to be in that role.
That's terrible.
There's no amount of money you could pay me to want to even, if I was even qualified to run the Fed, I absolutely not. So until recently, with stock market at all-time high, Bitcoin all-time high, gold all-time high, roughly, and unemployment running within their target band of low 4%, it's not really screaming we need cuts. Sure. Now, the recent weakness in the job reports certainly increases the odds of a trim. The whole global economy is kind of sluggish. Energy prices are kind of low. You have some degree of deceleration. That argues for a cut. I would also generally say tariffs, that's a different type of inflation than inflation from money supply growth. So they generally should look through tariffs per se. Just because that's more of a tax increase than a debasement driven price inflation. It's just a very different type of thing. So I do think they should look through that and mostly just think are we controlling bank lending at the rate we're targeted to? Now we can have a whole separate discussion. Should the Fed even set interest rates?
Right, of course not.
I'm in the camp that they shouldn't. But
should the Fed even exist?
Yeah. So it's like if they have this algorithm that they're supposed to roughly follow, which is keep unemployment, as low as possible, keep long-term interest rates moderate, keep inflation in check. They're kind of in a position where there's no right answer right now, but leaning somewhere toward moderately hawkish makes sense given the tools they have. I think we get an uptick in inflation. Partly will depend on what happened with tariffs. I think what will happen is you get a weak dollar. Therefore, you get a little bit of a boom in emerging markets. And the mechanism for that is that they have dollar-denominated debts. And also, they're trying not to have their currencies devalue relative to the dollar too quickly. So if the Fed's kind of hawkish, it forces a bunch of central banks around the emerging world to be somewhat hawkish. So if the Fed cuts, it allows a bunch of them to cut. And therefore, kind of multiple economies can get a little bit of a lift, which increases the demand for commodities, including generally energy. So you could get like another round of energy-led inflation, and just kind of higher commodity prices. And so I think that's the mechanism for how it would show up. I wouldn't still necessarily expect like a 2022 level of inflation, because we had like a 40% money supply growth in 2 years. Then we had, of course, the shock in energy prices because of the war in Ukraine. So absent some sort of huge energy shock, I wouldn't expect, say, 9 to 10% headline inflation and whatever Truflation was saying at the time. I would expect lower than that, but probably above the current level.